Thank you for coming and listening. I wanted to share an experience I had last week. I spent 4 days up in Des Moines, Iowa, at the Iowa Ag Show, as they call it. It's the third largest agriculture show in the United States. And so there were a fair amount of people that came through, all kinds of people. When I say all kinds, yeah, farmers, ranchers, suppliers even came to the booth. They were interested in what I was there to talk about. And so just as some examples, I had a gentleman show up with his daughter. She was probably 2. He was holding her. He looked like a big kind of Viking kind of guy. I mean, he was big and a long beard and blonde hair and all that. And he said that he was reading the book and he was really happy that he'd found a practitioner, which was surprising to me. He had not. So it was surprising to me because I think that everybody can find their way to the Nelson Nash Institute, which apparently is not the case. So I learned something. And he said he was really happy that he found a practitioner, and he found one in Iowa. So he told me that he was reading Becoming Your Own Banker. And I encouraged him to read. I had a number of books out there, 4 or 5 different books, by Carlos Lara and Bob Murphy and other ones that Nelson had authored and co-authored and all of that. And so I encouraged him to read some more if he wanted to, but certainly to reach out to me after he read Becoming Your Own Banker, and we could start the process of answering questions and help speed up his learning curve. But certainly having one book under your belt is a good idea. Then I also had, it was funny, I'll just share this little anecdote. When I would leave the booth and just go to a little section short ways away from my booth, and I could watch the booth, people would go in. And so I think it was the last morning, I walked away from the booth and a gentleman went in. And as I walked up to him, I could tell that he was wearing the same thing I was wearing, which meant that he was a vendor. And I just asked him if he'd ever seen these books before. And he said, yes, as a matter of fact, I've read that one. And that was Becoming Your Own Banker. And I said, so did you implement it? And he said, yes. And I said, oh, great. You're still practicing it? And he said, no. And I was like, oh, why are you not practicing it any longer? He said, well, at one point, I went to go take a loan and I found out I was going to get charged interest. And he said, that's not the way it was explained to me. And I said, oh, that's too bad. Because I would have told you that, yes, you're taking it from the general fund of the insurance company and they're going to charge you an interest rate just like a bank would, or anybody else that's lending you money. And he said, yeah, that really upset me. And, he used some other words as to how he really felt. But I said, well, that's really too bad. I can certainly understand why it would. He said, I was told that I was actually going to capture the interest. And I said, well, this agent, he said, well, the agent has passed away. And I said, well, he probably didn't do it maliciously. He probably just didn't know. There are agents out there, and this is why it's so important for people to go to the NNI, Nelson Nash Institute.org website and find a practitioner that has gone through the system. There are many people that will say, many agents that will say, yes, I understand this. I know how this works. I can set one up for you. And there probably are some that do understand it, because there have been some people that have come into the NNI and then left. They may have an understanding of it. But for the most part, if you want to be safe and be sure, pick somebody that's there. Because of these little incidences where something is misconstrued, it upsets the client and they say, I'm not doing this. This is bogus, So that's my plug for the NNI website. Anyway, it was very, very informative to me. I always learn things when I'm trying to get the message out, trying to reach more people about this concept. And so what I wanted to talk about was, when I met this gentleman, I said, well, that's really too bad, right? That you didn't understand that you were going to get charged interest. But I got to tell you, if you still have the book, when was the last time you read it? He said, well, when I found out about it 10 years ago. He said, I still have my policy, but I've shut it off. And I said, oh, well, so be it. You still have it. It's still growing. I said, I highly encourage you to read the book again. I read the book at least once, if not twice, generally speaking, twice a year, because it's a quick read. It's 98 pages. And actually, the more you read it, the faster it gets, because you can kind of you speed read after a while. You understand it. But every time you read it, you unfold another nuance that's in there that you might not pick up the first time. And you can do this with any subject, right? Any nonfiction, real subject. That if you continue to read the same book, you'll pick up more things, because every time you read it, you go away, live your life, you come back, you're a different person. You've grown. So your understanding grows as well. So I encouraged him. Well, so I got home Thursday night, and Saturday morning the phone rang, and it was somebody from Des Moines. I was half awake. I hadn't finished my first cup of coffee. And if you know me, I love coffee, and it gets me going in the morning. And I picked up the phone. I probably shouldn't have, I should have given myself a chance, but he got on, it was him. And he came on the phone and he said, hey, can you explain something to me? He said, if I go and I take a loan from the insurance company, it's going to be 5.5%. And as far as I can tell, my policy is only growing at 4%. And I said, yes. He said, well, why would I do that? That doesn't make any sense. It's going to cost me more than to take the loan than the thing is growing. And I tried to explain it to him, but I bumbled it. I wasn't sharp. I wasn't awake. And, I've done that a number of times. I get in a rush, I should be able to explain this. And I just bumbled it. And it seemed like the more I talked, the more I bumbled it. But after getting off the phone and, going through my morning, I was thinking about it, and I went, oh my God, I forgot that, which is, in my opinion, is the key to this whole thing, in the sense that, well, I shouldn't say the whole thing, but because there's all these psychological, what I want to say, gymnastics that you have to change the way you think about how money flows and how you react to different things. If you're open-minded or closed-minded, that kind of thing. He was very open-minded. And I say that because he called. I encouraged him to read the book again and then call me. Well, he hadn't read the book because he couldn't find it. It had been 10 years. So I bumbled it. And then later on, I sent a text and I tried to direct him to a spot in the book that would touch on it. It's a conceptual story. The grocery store, pages 15 and 16, I believe it is. And the thing that about that story is, if you think about the grocery store and then think about a bank or a farm where money is flowing through, or a business where money is flowing through, whatever it is, it's all the same. Money flows, right? So, but let's use the example of the grocery store that Nelson Nash talks about. At one point in the 2 pages that he's talking about it, he says, these are your captive clients, your wife, your son, your daughter, your brother, your sister. Why don't you charge them, instead of the retail price of, I think he says 60 cents or something like that is break even. Why don't we charge them 62 or 63, whatever percentage that is above and beyond what they pay for the product. So when you're thinking about the banking or the insurance paying it back, you're paying 5.5% over here to the insurance company. But what is your money worth to you? What is your money really worth? And it really should be more than what the insurance company's money is. For me, my money is worth at a minimum 10% of whatever I'm borrowing against, because we're taking it from the general fund of the insurance company. That's why they charge you the insurance. But when you're paying it back, so go online, pull up an amortization table, they're free, and run the payment. So say you took out $15,000. How long do you want to take to pay it back? At 10%, just as numbers. I haven't run this calculation, but let's just say it takes, you decide that you're going to pay it back in 3 years. And the payment is X at 10%. When you pay that back, instead of it taking 36 payments to get the money back to the insurance company back into their general fund, which releases your collateralized money that you used to take that loan, when you pay it back in 32 payments because you've accelerated it by at least 4.5%, depending on what you choose as a percentage. Because it could be 12%, it could be 15%, you decide. But what happens, and Nelson mentions this in the book on page 16, that when you do that, your grocery store will become extremely profitable. You'll probably be able to retire sooner. I like to say, retire the idea of retirement. It takes you so long, takes you a lifetime to gather up enough wisdom and understanding of life when you could actually be doing something. In other words, you're not going to work 50 hours a week like you used to when you were younger, maybe, but continue to work, continue to contribute is how I like to look at it. Another side note. But anyway, so say it takes 32 payments, just as an example. Again, I haven't run the numbers. It takes 32 payments. So you have 4 more payments because you said you were going to make 36 payments. And those 4 extra payments are extra. They can't actually fit back into the policy because it wasn't designed to take that big of a extra. You can design them to take extra, but because of, limitations in the policy, those 4 payments might go into a CD. You take the 4 months and you compile them and you put them into a CD, you put them into something that's getting you something, right? And you take another loan for your next trip around the world or whatever it is, or an addition on your house or a new car or a wedding for your daughter, whatever it is. And you do the same thing. And so that secondary fund grows again. And you get to a point where you have cash in that other account that you can use to start another policy, which is your banking system. When the word system means that there's more than one policy. If you have multiple policies, that's a system of policies that you can control the function thereof. And it grows exponentially because you're paying yourself. So you're paying yourself more than the 5.5% or 6% or whatever the insurance company is charging you. And depending on your age and health, when you start a policy, that will also designate what that policy is going to grow at. So this gentleman mentioned 4%, I think. I'm not certain about that. My memory says it was 4. But there are some people like myself, I'm older, I started it later, I'm at like 3.25. My policy has grown, but it's going to grow like that for the rest of my life. And it's compounding on top of itself over and over and over again. Compounding on dividends and interest that have become part of the principle, right? So this is really what I should have explained to this gentleman. And I wish I had, but I sent him something that might help him. But I wish I had been sharper. At that moment, I wasn't. So I bumbled it. And it seems to me I've done that with a number of things, building things and so whatever. Maintenance on the house, I bumbled something. It takes me longer than I expected to. So what I wanted to say about this experience was that this gentleman had given himself the gift of keeping an open mind. And he is going to read the book again. You can always start another policy. You can always re-gift to yourself the understanding. There's so much noise out on the internet now and YouTube and all these other platforms for videos and podcasts that's not accurate. There's some that is, but there's a lot that isn't. It's too bad. But anyway, he kept an open mind. He gave himself the gift of reading it again and starting again to look into it. That's all I can say. I don't know where he'll end up with it, but I congratulate this person. It's, in my opinion, it's a courageous act to start again, to always get up. If you've fallen down, and I'm not saying he fell down, I'm just saying, you in any situation like that, give yourself the gift to get back up. It's when you don't get back up that you can't take advantage of how great things can be, how life can be just beautiful. So I want to just touch on, I have some notes over here too, that there's a thing called, the acronym is EVA, and it stands for Economic Value Added. I've got this book right here. You can see it's a real thing. You can go out on the internet and just search for EVA and read about it. So it can be used for investors to look into a company to see if the company is a good investment. And that you can also use it internally, where if you have a project, and this is really how I first stumbled on it, was that it was companies began to value their own cash. There was a time when they didn't. They just would spend money that they had, their cash, and not think of it as an economic engine. They didn't think of it as that they were borrowing from themselves. You know, really, we either pay interest to someone else or we give away the potential growth of that money when we pay cash. So we're paying one way or the other. But companies used to not do that. They would just say, okay, I have a budget. Some head of a department would say, okay, you have X amount of dollars that you can spend on this project. What would happen when they'd go over budget? Well, if you're almost at the home stretch and you can't quite get there, you probably just ask for more money and they give it to you. But they weren't valuing their own capital. And so EVA, economic value added, has risen up out of the ashes and fallen away. People had forgotten about it, and it's come back. It was discovered, I think, back in the 1800s, probably sooner, because other people would come up with it, and then it would just float away into the ether of history. But it's a way that companies can pick a particular project or product they want to develop, figure out all the costs and all that, and what their margin or profitability needs to be as a company. They have a target that they need to hit for growth. And if they don't hit it, then they might reconsider that project if they use the EVA. The point is that all money needs to be respected, and not money, but capital. Money is just the exchange, but capital that you have, that you own, and personally in your own household, I would think that most people would think it's even more valuable. So there's many people that have started becoming your own banker and all that, started these policies that will even charge, I've heard, as high as 18%, because they really want it to explode, and they want to start another policy, start another system. So when, just as an example, at the height of Nelson's career, he owned 46 policies. And when he passed away just 4 years ago, he had 26. That was a system. And that system still exists within his family, because when he passed away and the money flowed into the family, they turned around and just started more systems, better known as more policies. And so that's the way I really should have answered that question, this gentleman. And so please forgive me for bumbling it. I probably should not have picked up and just waited and found out who this was, and maybe he would have left a message and I would have had a little time to think about it. But I don't know why. I don't tend to talk about it all that much. Even with clients, prospective clients, I don't necessarily talk about that. I don't know why. Maybe because I haven't been forced to, but now I feel as though it's going to become part of my discussion with them about understanding this concept and respecting our own money, not just the bank down the street when you borrow money from them. So anyway, I think that's about all I have today. Thank you for listening. Please subscribe or like, make a comment. I'd really appreciate it. It would be great. And share the video. That would also really be good to get it out there. So you'll see in the show notes, I'll have the book, the EVA book, if you want to get that. I'll have a link to that. And BYOB, Becoming Your Own Banker. But anyway, I really enjoyed going to the Farmer Show. What a great community. And the vendors, all really great. I actually have a couple of vendors that I'm talking to about this because they're very curious, about it as well. So anyway, thank you for listening and have a wonderful day. And I will catch you next time. All right. Bye-bye.